Hello and good morning, listeners. Welcome back to Almus Market Mornings with Jayaram Krishnamurthy, your morning brew of financial market updates. JK, we saw USD INR taking cues from the geopolitical developments yesterday, but the central bank managed to contain the flare ups in a very good and contained range. Meanwhile, the FIIF lose as well as the border concerns remain in the front to further influence the currency movement. An absence of either might suggest some directional movement. On the global front, the US economy continues to give mixed signals through the economic updates, as also observed by the numbers released yesterday for trade deficit and job openings. So, JK, what do you think of such updates and how should we be reading the markets?
Hey, good morning, Shikhar. Um, yeah, I think the rupee volatility has been well contained thanks to central bank actions on both sides. We had, one more test of the downside for the USD below 85. I think it's the third time that we tested and held, and that also ignited more import covering. But once again, in view of the prevailing situation on the geopolitics, RBI has been on the selling side as well at a higher level, not allowing market to get into any sort of a panic mode or even a speculative activity to put the markets on a uncertain mode. So they are containing the volatility for now. So but interestingly, while the spot volatility is contained, the implied volatilities has have actually risen quite a bit. So I was just observing that 1 month implied volatility has gone to 2 year high of 5.15%, and this means most dollar liability holders believe that this stability may be threatened later, and buying instead of buying outright forward with a forward premium, they are choosing to take option cover. It may also give them the benefit of the downside if dollar index falls and the dollar rupee also moves further down with flows increasing. But that is the strategy. But right now they are not leaving the whole upside unhedged. So that's why we are seeing these implied walls going up. But otherwise, Indian markets, yeah, yesterday we saw even the stock market hit a new recovery high. Technically speaking, it hit a 61.8% retracement of the entire loss from the all-time high, almost hit there, and some sort of a consolidation here with a holiday coming up and then followed by a weekend. Of course, before that we have lots of data from US also. Next week we have Fed meeting. All these things may result in some sort of a consolidation in the Indian stocks, and FI numbers have decisively turned positive for this month. So overall, with some aid from the central bank, things have been well contained as far as the Indian market is concerned. I think at least till this week, we may not see much of a direction move for the USD INR. But if you look at the global markets, April has been a very unique month. We had a few, host of factors, a host of market components moving big. We had a 7% drop in the dollar index from 104 to below 98, marginally below 98. S&P fell 15% and almost now recovered. 10-year had a 10-year yield had a big two-way move. It was first down on risk aversion, then when the US bonds got sold off, yields went up and threatened the 4.50% plus, and then again down after statements from US. They went into a 90-day pause on the tariff, and slowly we had some sober statements from the US government. So again, that was contained. Gold was up 12% from last month, gave up about half of it now, in the middle of the range right now. Uh, so markets had very big moves. Possibly now market is tiring with these moves and now look for some new triggers. Upcoming data, on GDP, inflation from either side of Atlantic may provide some food. But what really matters, as far as I'm concerned, is the policy moves, both from the central bank and the government. Trade negotiations, particularly with China, will be a big mover for the market if it improves. Everyone knows that the current levels of tariffs are not sustainable, and both countries are, of course, playing it the hard way, want the other to give in more. It's happening, giving in is happening in a very, very small measure right now, but hopefully things will get better. That better environment will definitely help, the overall global, risk measure, and can lead to some more unwind of the haven trades that we saw. That means gold can correct more, euro can correct more. All these things have been bought as a safe haven. Yes. So on the monetary policy, as I said yesterday, also Fed could have a lot to chew upon before they meet next Wednesday. The inflation number, GDP number. GDP is expected 0.4%. Now that could have been pulled down a lot by the record 160 billion March deficit by the US. 5% rise in import, 1.2% rise in exports. Of course, expected tariff impact would have made preponing a lot of imports, but still that number is a staggering number. Maybe if it can be worse than 0.4%, sorry, 0.4% as well. But people would call this as one-off. But whether it improves back to the previous levels of 2.5%, depends on how the tariffs evolve. Because if the tariffs remain high, then it could be higher import costs, and we can have the trade deficit remain slightly on the elevated side. Job market also gave mixed indicator. Job openings were at a 6-year low, sorry, 6-month low. Job openings, but the quit rates were also higher, which means that people were quitting jobs and finding. So the data on jobs or the employment is not really giving that much of a evidence that sharp slowdown. Yes, there is some slowdown, but not as much as the market has been expecting. I think we would rely on more on the ADP number ahead today, and also the non-farm payroll number, which will come on Friday. So as I said, these numbers will be giving a lot of food for Fed to consider when they meet on Wednesday. By then, possibly we have some progress on the trade talks. In fact, Treasury Secretary had said that with one country they have already finalized the trade deal, almost reached a conclusion, but they don't not naming the name of that country, because the other country also has to finally agree for it. So we may expect some announcement. So these things will be in the Fed's consideration. My sense is that they could be slightly more dovish than what they were in the last meeting, particularly as they consider the tariff-related inflation as a transitory. Whether they will shift more focus to the growth aspect is what I'm counting on. As far as the government policy measure is concerned, now that the tariffs are under negotiation, we have 2 more months, a little over 2 months, by when there can be some sort of settlements. Eventually the discussions may also move towards the currency, where that's the other tool which the government wants to explore for reducing their trade deficit, huge trade deficit, and particularly with China, Japan, and Europe is where they will be. I think at some point of time, these currencies can become a matter of discussion, and that could keep the markets volatile for the dollar. Yes, in the meantime, investors have been buying back more of US assets which they had sold off. So, in the absence of very big equal alternative to the US assets and US markets, that's very natural that investors want to be positioned in US assets, at least to some extent. There cannot be a wholesale reducing because of lack of credible alternatives. That will support the dollar as well. So overall, I think after the big moves, my conclusion is we will consolidate for some time, look for new triggers that can come from the policy moves or the policy statements, and of course how the trades go about. And India, we await what happens in the border front, after particularly after yesterday's authorities gave the army heads to take appropriate action according to their discretion. So we will see what sort of action happens in the coming days, and market will be very closely watching for those developments. Thank you.
Okay, JK, and yes, folks, as JK mentioned, we can expect to see some bit of consolidation continuing while we, prepare for the updates on the trade and the tariff front from the US as well as the other nations. And it's been, moving around the market that the rumors that US has reached one of the trade conclusions with one of the nations and might get a confirmation pretty soon. On the economic front, yes, the job updates do not provide any sharp slowdown signs, but I think it'll be much more better, as like you mentioned, to wait for ADP and NFP numbers for a better clarity. Although the markets do provide signs of tiring from the current set of updates, and they await cues to pick the direction. We've seen the global equities move, yields move in both the directions. So these triggers might provide the direction that we are looking for. On the domestic front, the central bank's presence was felt on both sides, which was also, in a way used to maintain the volatility. Although the option implied volatility reached a new two-year high on the flow front. FI numbers, as we mentioned at the start, continue to be decisively positive for the month of April now, and a recovery high of the equities was observed. That's it for today, folks. We shall come back again tomorrow. Sorry, we shall come back on Friday with another round of updates. Thank you so much for joining in.